Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The yen in focus as Japanese stocks slip the most in months. On growing speculation, the Bank of Japan will raise rates. Investors look ahead to US inflation data tomorrow. US President Joe Biden warns Israel against invading the city of Rafah, calling it a, quote, red line. That's as ceasefire talks remain deadlocked. Plus, Aramco's $31 billion gift, the world's biggest oil exporter, ramps up its quarterly dividend despite lower oil prices to help the government plug its budget's deficit. Let's check in on the markets and a bit of profit taking, particularly across the Nasdaq on Friday. We had the jobs data, of course, out of the US, the unemployment rate ticking up to 3.9%, but broadly the jobs picture looking and remaining relatively resilient in the US. European stocks, by the way, ended Friday at a fresh record. Today, though, European stocks pointing to losses of 0.5%. The data focus for us this week, of course, is the inflation print out of the US on Tuesday. It's worth noting, though, that inflation out of China actually managed to tick up in the most recent reading, suggesting that maybe that deflationary funk in China is starting to turn. FTSE 100 futures at 7,638, pointing lower by 0.3%. You're just down 0.1% on S&P futures. Nasdaq futures pointing lower by just 26 points. Let's flip the board and look cross-asset then. Yes, the focus today is very much on what is happening with Japanese assets. Of course, the strength coming through for the Japanese yen and yields up as well, and what that's doing to the equities picture in Japan, as we know. Let's first start with the 10-year, though, stateside, 4.06 as we look ahead to the inflation print tomorrow. Core expected to tick up for the month, 0.3%. Year on year, you're looking at potentially 3.7%. Does a softer inflation print out of the US lead to a Goldilocks rally and a continuation of the upside that we've seen broadly, of course, year to date for US stocks? The Japanese yen in 147, there's the strength. What is the next level for this? Do we cross through 145? Does 140 provide a support for dollar yen? Currently, you're seeing strength again for the Japanese currency, weighing on the equity story there. Brent, $81 a barrel, just short of $82 a barrel, down 0.5% so far in the session. And iron ore taking a big hit, and remaining concerns that not enough support is coming through for the real estate sector in China. Currently, that commodity down 5.4%. Let's get more details then on how the Asian markets are faring with Avril Hong standing by in Singapore. Avril, what's standing out to you?
Yeah, we have a number of things to unpack. Standing out the most, GDP print from Japan, because there was an upward revision, even though it was lower than consensus. What investors are focusing on is how the Japanese economy avoided a recession, a technical one, and that's building the case for the BOJ to exit negative rate policy. Let's flip the board, because that has implications cross assets. I want to take you there and taking a look first at what we're seeing in the Japanese currency. As you said, it was strengthening. That's putting pressure on the equities, but also on bonds. What we're seeing based on those expectations of what we're going to get from the BOJ come next week, not just because of that GG Press report saying that we could see an exit from negative rate policy, but also yield control as soon as next week. We also have those wage negotiations, and so far those reports show rises upwards of 5%. That's going to be key to watch. We also have Toyota Union reporting the results of some of those negotiations later in the week. So all that could be feeding into those expectations for the Japanese central bank. Now, topics earlier declined by as much, the most since April 2020, just to give you a sense of just how steep the losses are in the equity space. Pairing that by the close, as did the Nikkei. Let's flip the board and take a look at some of the movers. And note here, it's not just the tech names that dropped, the AI, the chip-related ones, no thanks to the handover from their US counterparts last Friday. It was also the Japanese lenders that declined. Bright spot in Chinese names, the tech ones, the consumer-related ones, after the CPI print over the weekend from China, showing the first rise since August. Flip the board, I want to show you what we're seeing cross assets in China as well. The Hang Seng recovering from what we saw last week. And despite this green on the screen, onshore, offshore, note here that even though we saw some of that positive sentiment coming through, there were weekly losses for the Hang Seng as the Chinese NPC underwhelmed. Tom.
OK, Avril Hong in Singapore with a market breakdown. Let's get more then on the National People's Congress, which of course wraps up today. China's annual session of Parliament, then the NPC wrapping up in Beijing in less than an hour, in fact, with perhaps more emphasis on what leaders did not do than what they actually did. For more, let's bring in Bloomberg's Alan Wine, who's been watching all of this for us. Alan, what then have been the key takeaways this year?
Well, like you said, there are no big surprises. On the economic front, the economic targets like GDP and the fiscal deficit were in line with expectations. That said, the target of around 5% for the GDP is actually at the upper range of what most economists expect. And even Premier Lee said that it's going to be actually kind of hard to achieve. In terms of how the government is going to achieve these targets, we know that basically the indications that the government is going to increase spending through the issuance of 1 trillion of these special, ultra-long special government bonds. So more fiscal stimulus and not as much monetary stimulus. And basically the priority is going to be tech innovation and upgrading industry. And they actually came up with some really cool slogans to sort of symbolize what they hope to achieve. One was called New Productive Forces. Basically, they're going to use new technologies to upgrade traditional industries. And another slogan that came up was worry-free consumption, where they're going to allow consumers to sort of upgrade the consumer and household products. I guess the second main takeaway was on the political front, where I think we see President Xi continuing to consolidate power. One is they're going to pass this special organic law later today, which would tighten the Communist Party's grip on the cabinet, and also the cancellation of Premier Lee's press conference with the media. Normally, this has been a tradition every year, but not so anymore, which represents in some ways a downgrading of the post, as well as, I mean, it's sort of increase foreign investors' concern about lack of transparency within the government.
OK, Alan Wan. Well, cool slogans from the National People's Congress is new to me. So thank you for that detail, Alan Wan, as we look to the wrapping up, of course, of the National People's Congress in Beijing in a little under an hour's time. Let's switch focus now. US President Joe Biden has warned Israel against an invasion of the city of Rafah in southern Gaza. This as ceasefire talks between Israel and Hamas remain deadlocked at the beginning of Ramadan.
There's red lines that if he crosses, he cannot have 30,000 more Palestinians dead as a consequence of going after. There's other ways to deal with the trauma caused by Hamas.
OK, a red line being drawn there then by the US President Joe Biden. Let's bring in Bloomberg's Paul Wallace for more on this. Paul, where do we stand in terms of these ceasefire talks? Ramadan has started. How dangerous is this moment?
Hi, Tom. Yes, there were obviously high hopes that a ceasefire would be in place for the start of Ramadan. That obviously hasn't happened. Talks are continuing, however, not on a, let's say, in a formal in-person capacity. There were negotiators from most of the mediators and from Hamas in Cairo last week, albeit not from Israel, but they have now left. However, I think there is still a chance that we could get a ceasefire sometime during this month. There's no inevitability, but I think it's something that Israel is prepared to accept if it's along the broad lines that have been discussed already, which is roughly a 6-week truce in return for about 40 hostages that are still held by Hamas being released from Gaza.
And Paul, when I hear the US President talking about red lines, it makes me think of red lines that were previously outlined or at least articulated by former US presidents around, for example, Bashar al-Assad in Syria, maybe red lines for Russia and Putin. But we're talking about Israel, of course, an historic ally of the US. How bad are tensions then between Biden and Netanyahu for Biden to be using this kind of language?
I think it's clear that those tensions are growing, and they're growing pretty rapidly. Until now, Biden and the US haven't totally ruled out Israel attacking Rafah. They've said that it can't happen under the current circumstances, which essentially means that civilians that are there, the 1 million plus civilians that fled to Rafah from the rest of Gaza when the war started, have to be allowed out first. And Israel had always pledged that would happen, that they would open a safe corridor or some such to enable them to leave before an assault on the city, which is still thought to hold about 5,000 to 8,000 Hamas fighters. But yesterday, Biden seemed to rule it out altogether. He didn't qualify that red line remark by saying under the current circumstances or until civilians have been allowed to leave the city. So I think that's very much a hardening of the US stance. Read literally, the US now believes Israel should not under any circumstances attack Rafah. We'll see if US officials dial back Biden's comments somehow. The other big question is what leverage does the US have to stop an attack on Rafah if Israel pushes ahead with its plan? And a lot of people would say it has very little, that if Israel wants to go ahead, it will, and there's nothing Biden or the US can do to stop it.
OK, Bloomberg's Paul Wallace, thank you very much indeed with the latest from that region. Now, traders are on alert, of course, for hotter than expected US inflation. And the data is expected, of course, to be published tomorrow. For a preview on the numbers, let's bring in Bloomberg's Jill Desis with the details. Jill, of course, January CPI was a surprise for the markets. It came in hotter than expected. How are we thinking? What is the expectation around the data tomorrow and what the market reaction may be then?
Well, look, Tom, I think that this data for February, the worry is that it, like January, comes in hotter than expected. I think we are expecting at least some resilience there. The question will be whether or not there's enough of a cooling off here to give us more insight into what the Fed's rate cut trajectory might end up looking like. I think bigger than anything else, Tom, the reason why this inflation print is so important is because it's coming just about a week out from the Fed's next meeting. We know that they're not going to cut rates in March. They've telegraphed that pretty well, but there's a lot of thinking about, what is the discussion going to be like among FOMC members next week? What's Powell's press conference going to be like? Are we going to get any clarity on whether, this inflation data combined with some of the recent jobs data that we got is going to be enough to actually push the Fed toward cutting interest rates in maybe May or even, say, June or so? I think what traders are really looking out for there is some kind of clarity on what that trajectory looks like. I mean, if we've got really hot February CPI data, then you might see that recent rally in the bond market cool off. You might see that push on gold start to ease up too, since gold benefits from more of a lower interest rate environment. So ultimately, that's really, I think, what's factoring into the calculus for traders right now. What does this tell us about what Fed officials are going to think going into this March meeting? Now, I think, from that point on, we'll actually see, what the data, again, like policymakers really like taking all of these different data points into consideration with each other. That jobs report on Friday was a little bit confusing. We had, as you said, the higher unemployment rate, but then we also saw those non-farm payrolls continue to be pretty resilient. So we'll see if this February CPI data gives us any clarity into what's happening with the economy right now and how that's going to inform the Fed's decision.
OK, Jill Desis with an excellent preview. Thank you very much indeed of one of the key data prints, of course, of the week. Talking of what else is on the agenda for us this week, before we get to that CPI print out of the US tomorrow, we're going to get UK jobs data and, of course, a really interesting time in terms of how we think about the Bank of England and next steps for the central bank here. As Jill was saying, markets increasingly pricing in for the Fed and the ECB a move potentially around June. For the Bank of England, though, we're talking August. Does the data tomorrow on the labour front and the jobs picture in the UK change that dynamic? There is a view that inflation is stickier and, of course, the UK economy is slightly more resilient. We dipped into recession towards the end of last year, but even the Bank of England governor has suggested that the data is starting to look a little more positive. So we look ahead to that data tomorrow. Then, of course, later in the day, we get the CPI print out of the US. We've got the preview there from Jill Desis. The expectation is that for core, year on year, for the month of February, you're going to see 3.7%, just slightly below the previous month of 3.9%. But of course, well above that target for the Federal Reserve. But the volatility around this print is going to be interesting. On average, over the last year or so, you've seen about a 0.8% move in terms of the S&P in either direction on CPI day. So look for that in terms of the market reaction. On the earnings front, VW reporting earnings. We're going to be looking, of course, for the story around China. To what extent is that market softening or not for VW? The US market also important as well. And then the demand picture around electric vehicles. So that earnings story is going to drop on Wednesday, and it'll give us further clarity in terms of some of those factors as we weigh up the margins for these automakers and pushing ahead. But the outlook, of course, will be in focus for VW as well for the rest of the year. Now, you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. And there's a number, of course, of key stories unfolding on that page right now. Japan firmly in focus. We see an equities rout, at least in the session today, with stronger yen in focus and building speculation that maybe next week, the BOJ will end its negative rates policy. The growth coming out slightly stronger than expected in Japan. So that is in focus. Biden, of course, and his warning around a red line for Israel. And then an election and a vote in Portugal with the centre-right coalition winning the polls in Portugal. All of those subjects being dealt with in today's Daybreak edition. Coming up, the world's biggest crude exporter raises dividends, and that's despite a drop in oil prices. We take a look at what Saudi Aramco's big payout means for the kingdom's budget. That is next. Welcome back to Bloomberg Daybreak Europe. Happy Monday. Let's check in on the oil price. Currently, Brent trading lower by 0.4%, just below $82 a barrel, 81.74. On WTI, you're looking at $77 a barrel, down 0.5% so far in the session. We're going to get some updates from the IEA and OPEC as well later this week, which may give some sense and some clarity in terms of the demand-supply dynamics that are playing through, of course, for this crucial commodity. But the top story of the day right now when it comes to oil is what's happening with Saudi Aramco, because that company has hiked its quarterly dividend to $31 billion. $31 billion despite a fall in energy prices and lower production. The world's biggest crude oil exporter provides, of course, much of the Saudi government's income, with the payout becoming ever more vital as the country looks to diversify the economy from oil. Let's get the details then from Bloomberg's Anthony Di Paolo, who's standing by for us. Anthony, so income coming in lower last year, down, 20%, 25%, and yet the dividend's been hiked. What's going on?
Yeah, well, this is a trend that we saw through a lot of the big oil companies in this earnings period, where the net income is dropping because we had that huge year in 2022 when oil prices and the commodity complex in general spiked. So we had those big results the year before, and last year they're coming down, but still very strong numbers. And a lot of the companies are returning money to the shareholders either via dividends or buybacks in the case of some big oil. Saudi Aramco is combining some of that 2022 windfall with the 2023 earnings, and they've put together this special dividend. So that's helping boost that payout, which goes mainly to the Saudi state. They've also increased the base dividend. Again, already in the fourth quarter, they did an increase in that dividend. And so that gives some kind of focus to the shareholders that they know there's a downside there. That's the message from the company, and they're going to continue to share the upside. So they're really trying to make that a more attractive prospect to some of those outside investors, while also shoveling that money back to the Saudi state, Tom.
What does it mean then? There's been reporting they're looking to revive a follow-on offering potentially later this year. What is the appetite likely to be for that follow-on offering if it comes to pass?
Yeah, well, they didn't have much luck before in terms of getting that kind of big interest and a lot of traction internationally that they wanted. So there was a lot of local and regional interest in that initial IPO of Saudi Aramco. They are potentially looking at another listing later this year, so selling some more shares. And there are some issues around that. Well, there's the governance issues, because it is the Saudi state that does control. We're seeing that dividend as the Saudi state needs the money. We're seeing that other decision in January where the Saudi state decided that Aramco shouldn't go ahead and increase its maximum spare capacity. So a lot of these directives are coming from the government, and that is a concern for the shareholders. The shareholders won't have much voice in the company because it remains majority, almost completely state-owned. So they're really there for the dividend, but the idea here is that they want to give some prospect of growth to the shareholders to try to attract some more investors into the company, some independent investors, Tom.
Do we have any updates? There have been reports around Saudi Aramco's potential investments in US LNG. Any updates on that front? What are their ambitions in terms of US LNG?
Yeah, that's an area that they're really interested in with the shale developments there and lots of gas coming out of the U.S. There's that big development on the U.S. Gulf Coast of LNG coming out, and it's going to be one of the main contenders for LNG production over the decades to come. U.S., Qatar, Australia, those are kind of going to be the big exporters. So there's a lot of growth there, and Saudi Aramco wants to get in on that. They want to be involved in a market that they're allowed to trade, that they're able to trade with those cargoes able to go anywhere. The domestic gas in Saudi Arabia is going to mainly stay domestically. They want to use that gas for power in the kingdom, and then use some of the other gas that they've discovered as a way to create a hydrogen, blue hydrogen, and then export that. So their focus on international LNG is really a trading play, trying to get in there those assets and give them something else that they can buy and sell globally. So they really want to move that, and the U.S. is one of those main areas where they are interested.
Okay, really interesting. One certainly to watch in terms of how that evolves. Top line, Anthony, what is the picture looking like for Saudi Arabia's economy as it continues this diversification effort? And what are the budget constraints at this point?
Yeah, I mean, as you say, it is an effort, the diversification so far, because they really need to take these oil earnings, which is clearly the main earner for the Saudi government. They need to take those and put those into industries and develop new industries that are going to be able to support the country economically and create jobs going forward as the world shifts away from oil. Of course, Saudi Aramco has got a very long view on oil use. They want to continue selling oil for transport, selling oil that can be turned into chemicals to make plastics and things that we'll need in electric cars and batteries, etc. And they want to continue selling that gas. So they've got a long view on the energy industry. They expect to be in this business for another several decades. But what they really need to start doing is taking those oil earnings and then putting them into those industries in the kingdom. They are having some issues bringing in the kind of foreign direct investment that they do need, so they need to step up that as well in order to get those big projects really rolling and get those industries developed.
Okay, Bloomberg's Anthony D. Powler, thank you very much indeed, with a lens on Saudi Arabia on the back of Saudi Aramco's ramped-up dividend, of course, and what that could mean more broadly for the economy of Saudi. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some of the other stories we are following today. The US Justice Department has opened a criminal investigation into the January mid-air blowout of a Boeing 737 MAX fuselage panel on an Alaska Airlines flight. The airline says this is standard practice for the DOJ and that it doesn't believe it is the target of the inquiry. Bloomberg has learned that Reddit and its investors are looking to raise as much as $748 million in the company's IPO. Sources say the social media platform plans to sell shares in a range of $31 to $34 each, seeking a valuation of as much as $6.5 billion. Reddit has been working towards a listing since its initial filing in 2021. And Oppenheimer has picked up a total of 7 Academy Awards, including Best Picture and Best Director for Christopher Nolan. Barbie's 8 nominations amounted to just 1 trophy for the Best Song in a night that saw Hollywood's old guard return to glory amid disappointment for streaming companies. Disney's Poor Things won 4 awards, including Best Actress for Emma Stone, beating Lily Gladstone, who was in line to become the first Native American to win an Oscar for her role in Apple's Killers of the Flower Moon. Coming up, investors look ahead to US inflation data tomorrow after, of course, Friday's mixed jobs report. Our markets wrap is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The yen in focus as Japanese stocks slip the most in months on growing speculation the Bank of Japan will raise rates. Investors look ahead to US inflation data tomorrow. US President Joe Biden warns Israel against invading the city of Rafah, calling it a, quote, red line as ceasefire talks remain deadlocked. Plus, Aramco's $31 billion gift, the world's biggest oil exporter, ramps up its quarterly dividend. That's despite lower oil prices, and it's to help the government plug its budget deficit. Let's check in on these markets. A bit of risk off across the equities market with the context that, of course, US stocks have rallied, the last 16 and the last 19 weeks. That run, the strongest and longest run of gains that you've seen since the 1960s in the US. That's with the S&P. Currently looking at European stocks futures down 0.5% in the session. FTSE 100 futures pointing lower by 26 points. Here in the UK, we have wage data, of course, out tomorrow. It's going to be very consequential in terms of how you think about the Bank of England. S&P futures currently back below 5,200, 5,186, just pointing lower by about 0.1% after the losses on Friday. Nasdaq futures currently down 0.2% after dropping a little over 1.5% by the end of the Friday session. Currently trading at 18,262. And of course, it is inflation data of the US. It's going to be really consequential in terms of where the thinking on the Fed lands. Let's flip the board and look cross asset then, with the view then on CPI. The expectations that core CPI out tomorrow out of the US will come in year on year about 3.7% for the month of February. The US 10-year currently at 4.06. The yen, again, as we said in the headlines, in focus for us today, the strength coming through for the currency. Currently just 146. Not a lot of movement so far, but of course it has rallied in the last few weeks on expectations the BOJ will end its negative rate regime at that meeting next week. $81 a barrel on Brent. We're looking ahead to reports out of OPEC and the IEA later this week. Currently down 0.4%. And iron ore taking a big hit. That really is the commodity of the moment on the softness again. The concern that not enough policy has come through in terms of the NPC, the National People's Congress in China, to support the real estate market. 108 on iron ore, currently down close to 6%. Let's get to US CPI then and the preview. The latest data is out tomorrow. Traders then on alert after last month's surprise inflation print coming in higher than expected. Let's bring in Bloomberg's MLife, Mark Cranfield, of course, who's been thinking about all of this in great detail. Mark, which assets then likely to be most affected by the US inflation print tomorrow?
Well, inflation means it's a big week for US Treasuries, so that means it's a big week for all asset classes, really. But certainly how the response goes in the US rates market really means a lot for everybody. So all eyes will be on whether or not Treasury traders think that the outcome from the CPI is enough to convince the Fed to lower interest rates in June, or whether we all have to take a step back and move a little bit further out in the year. So really that's what it comes down to. Is increasingly what we've been hearing from Federal Reserve people is that they want to delay a rate cut until the second half of the year. June looks like a high probability at the moment, but we really need a couple of CPI numbers to confirm that that is the case, because clearly some of the data has been way too strong from the Fed's point of view. It's given them a reason to be less optimistic about the outlook from that point of view. So certainly there are some people thinking the CPI number will be another hot one today. There's nothing really in the track record to suggest it has to be the case. It's really an open question. But certainly with Treasury yields in the 10-year close to the 4% area, it really is a very big number. If we go on to a 3 handle, people will get very excited that a rate cut is coming in the near future.
OK, Jay Powell, of course, last week saying not far from that point where they cut rates. And we'll get maybe the CPI print, of course, gives us clarity on what not far means for Jay Powell. Meanwhile, Japanese stocks, look, up still year to date, 16% or so, but taking a thumping today, Mark. The narrative had been from strategists we've spoken to, it's not just about the yen softness that we'd seen prior to the last few weeks, but it's also around corporate governance. I wonder if that corporate governance story has kind of been derailed by the price action today. What is behind the move lower in Japanese stocks?
I think it's been exaggerated because of the time of year, really. So we've had a torrent of media stories, which really now is ramping up the pressure on the markets to think that the Bank of Japan may actually move in March, which really was a bit of a long shot. Even just a couple of weeks ago, people assumed it wouldn't be before April, possibly even July. We've had almost daily reports telling us that the Bank of Japan are getting close. They're even talking about taking away yield curve control. All of this is suddenly coming together, and we've still got a few days to go until they meet for the March meeting. So suddenly, even the equity market has got a bit nervous, and the fiscal year end is coming up at the end of March as well. So if you're traders, investors, sitting on very good gains, which there have been for the Japanese market this year already, and you're coming up towards the end of your financial year, probably you're saying to yourself, well, there's really from here, there's not much upside for me. I want to go to the sidelines. I want to book some of these profits because the Bank of Japan may just do a curveball and they may do everything all in one go in March rather than string it out over a series of meetings. So that's really where we are. People looking at the situation saying it's better to book something now rather than wait to see what the Bank of Japan has to do.
Mark, a top story for us today around and beyond Japan is this short trade around volatility booming in the ETF complex. What do you read into this story?
Well, it's not unusual when financial markets, especially in the United States, when equities have had a relatively clear trend and people are confident that it's going to go on. AI has been driving a very good rally, as you were saying earlier, 16 out of 19 weeks, markets moving. That makes people confident to sell volatility. It means that they will try to enhance their returns because they think the market is in a fairly clear direction, particularly for the downside. They're willing to sell put options to earn the extra income because they don't see the market reversing quickly to the downside. Of course, the more people that join that, as this story says, you get a lot of people join the same trend. Too much money is involved. All you need is a little bit of disconnect now between what policymakers say, or you get an unexpected event in the market and suddenly it can all turn into a big mess. And the so-called Volmageddon events take place. Last one was about 5 years ago. So certainly it could be triggered at any time, but certainly the amounts of money involved now make it more likely to happen in the next few months rather than the next couple of years, simply because the number of people that would need to change direction is so big. So a bit of a herd instinct. So if something triggers it, for example, if the Federal Reserve looks at the inflation numbers this week and say there's no way we're cutting rates this year, that could well put equity markets into a spin and we may get a big event off the back of it.
OK, Mark Cranfield from Bloomberg M Live on those potential Volmageddon risks, with a preview, of course, of US CPI and what is reacting and what is leading to the downside coming through for the Japanese equity story in the session today. Mark, thank you very much indeed, as ever. Now, to some of the other top stories we are following. Portugal's centre-right AD coalition has won elections held this weekend in a tight race, which also saw support for the far-right surge. With almost all votes counted, the AD secured 79 seats, 2 more than the Socialists. Far-right party Chega, which was only founded in 2019, recorded the biggest jump, quadrupling its representation. Now, Germany is bracing for further travel chaos after unions representing train drivers and airline staff announced further walkouts. A 6th strike by train drivers coincides with a 2-day strike by Lufthansa's cabin crew after ground crews stopped working last week. More delays and cancellations are expected as passengers get caught up in the latest escalation of wage disputes in Europe's largest economy. And staying with Germany, Bloomberg has learned that the Netherlands is closing in on a deal to sell the TenneT power grid to the government in Berlin. The possible acquisition comes as Germany seeks to bolster its energy security amid uncertainty, of course, triggered by the loss of Russian pipeline gas. Details of the transaction, worth some 22 billion euros, could be announced in the coming days. And India has signed a free trade pact with 4 European countries that the Modi government says will create 1 million jobs in 15 years. The deal with non-EU countries, including Switzerland and Norway, has been 16 years in the making. India gets private sector investment commitments in return for the Europeans securing easy access to Indian markets and products. Now, ARK Investment's flagship innovation ETF had not held any NVIDIA shares for about a year. We asked CEO Cathy Wood whether she regrets that decision and what might change her mind about the stock.
We wrote it most of the way up, but I'll tell you what we did. And this is, as a portfolio manager, it's not one action, but what it causes in terms of another action. Last year, we sold in the flagship NVIDIA and put it into Coinbase. Coinbase, I believe, is up at least as much as NVIDIA. And it is much less well understood. The whole crypto movement, the crypto asset movement, Bitcoin as a new asset class and so forth, is not well understood or completely accepted out there. So we prefer to go where others are not traveling as much. And, as we were moving out of NVIDIA, we were saying, okay, regulators are trying to crush Coinbase here, and we were buying it on every dip. NVIDIA happened to be one of the sources for that purchase. So it's not just what we do on the sell side; it is what we do on the buy side that you have to look at. And yes, we do hold it in the more specialized funds, but we've been taking profits there as well for reasons I just described.
Yeah, and to be fair, you're right. Coinbase is up about 620% since the end of 2022. So that compares with about 530% gain in NVIDIA. Is there anything, though, Kathy, in the NVIDIA story that would make you rethink the name and want to become more aggressive on it?
Yeah, if the price came down a lot, we would. The rate of return expectations
or a split.
We have.
Would a split do it? Because I know we've been
no.
Okay.
That wouldn't change. That wouldn't change anything. No, no split adjusted then the price. So if you look at our portfolios, what we're trying to capitalize on with a Palantir, for example, are the next stages of this AI revolution. What we're seeing in the GPU side of things is NVIDIA, all praise to Jensen Huang. I mean, just unbelievable company execution, vision, and so forth. And it's not over. It's going to last a long time. But there are going to be many other companies benefiting from AI. The productivity lift alone is going to be massive, the most massive productivity lift in history, we believe. And so this AI revolution is going to be broad-based and is going to benefit a lot of companies. On the GPU side, of course, we have AMD as competition, but many people do not understand that there's a lot of other surreptitious competition evolving out there. Each of the hyperscalers is evolving its own chip strategy. You have a Tesla that has designed its own chip for an AI chip for the more specialized autonomous driving opportunity. And I think you're going to see a lot of companies developing more specialized chips. We know that NVIDIA, of course, will segment the market as well. So we just think that a lot of the assumptions for NVIDIA, that this is NVIDIA's market and it's alone, that those are changing.
OK, ARK Investment CEO, of course, Kathy Wood, speaking to Bloomberg's Carol Massa. Talking of the likes of NVIDIA, let's check in on the Magnificent Seven, because something has happened year to date that has started to evolve and really raises questions as to whether or not we should ditch the Magnificent Seven and make it the Magnificent Five, or indeed the Magnificent Four. Because here's the split, here's the division then. You're seeing the gains coming through from the likes of NVIDIA. Just year to date, that stock is up about 80%. Tesla, which is normally part of this magnificent story, has slipped, meanwhile, year to date by about 30%, down 30% year to date, close to that for Tesla. Concerns, of course, around the demand for electric vehicles, concern about competition coming through from EVs out of China, concerns around the consumer starting to be worried about the push around EVs and whether or not, in fact, they want an ICE engine to get that duration and that drive. Apple, meanwhile, year to date down around 12%. Again, the China story is a drag for Apple as well. Expectations around a new driver revenue for Apple, that hasn't quite come to pass. So whether or not you carve out Apple and Tesla, because right now there is this division that's come through, is that a story that sustains itself, or is there a turnaround in the narrative when it comes to Apple out of China, or indeed Tesla and the demand out of EVs? Because for now there is a split, and there's a really relevant question as to whether or not you have to rebrand the Mag 7. Just something to flag for you as we think about the upside that's come through for the likes of Nvidia. Meanwhile, there has been a concern as well, as we flip the board, around the concentration of the gains that have come through for the S&P within the Mag 7. But in fact, the S&P 500 on an equal weight basis, so that's when all the constituents are given the same weighting, whatever their market cap, whatever the company size, all the constituents are given the same weighting. In that case, the equal weight S&P has actually overtaken its 2022 peak, suggesting that there is this broadening again, which should assuage some of those concerns around the concentration risks. Coming up, China's NPC is wrapping up. We're going to take a look at why there's been more of a focus on what leaders did not do and what this means for the world's second biggest economy. We're going to bring you insights from one of the smartest people on China and that economy. Stay with us. This is Bloomberg. Welcome back. Now, China's annual session of Parliament, the National People's Congress, wraps up in Beijing in less than an hour, in about half an hour's time, in fact, with perhaps more emphasis on what leaders did not do than what they actually did. Joining me now is Michael Pettis, Senior Fellow at Carnegie Endowment for International Peace, and someone who has followed the story of China's economy for years in granular detail. And few people have the kind of insights that Michael Pettis has. Michael, thanks for joining us this morning. One line that stood out to me from your notes to us: consumption. The only potential engine of growth for 2024 for China is consumption. Just unpack that line for us.
Well, you know, for a large economy, there are only two sources of growth: investment and consumption. The trade surplus doesn't really matter. And if you go through the various components of investment, there are three big areas. There's the property sector, which at best will stabilize and probably contract this year. There's infrastructure investment, but there's increasing evidence that Beijing is very concerned about the sort of non-productive direction of infrastructure spending. So we're already starting to see some constraints this year. And then finally, there's the big shift to manufacturing. But as you know, an expansion in China's share of global manufacturing, which is what this requires also that the rest of the world accommodate it. And it's pretty clear that the rest of the world does not want to accommodate an expansion in Chinese manufacturing. So we're left with consumption.
And they've been reluctant up until this point, Michael, as you pointed out, to go down the route of cash handouts to households. But you think that maybe changes towards the end of this year?
Yeah, because when you think about how we can get consumption to drive the market, there's basically two ways, right? One way is we hope for a revival in confidence that sets off that revival in consumption that we were all expecting last year. That could happen, but there's no particular reason to expect it to happen. And if it doesn't happen, then what we're really left with is fiscal stimulus directed to the household sector. Now, China has said that it won't do that. This is what the US and Europe did, for example, during the COVID period. They said they won't do that, but I don't really see any alternative. If the other things don't work and that's all you have left, then basically that's probably what you're going to have to do.
There's a line that they're going to shift. What the policy focus is on shifting from infrastructure investment, property investment, to high-end manufacturing investment. What is the constraint to that policy play?
Well, you know, China is about 17–18% of global GDP. Consumption, Chinese consumption, is about 13% of global consumption. Manufacturing is an astonishing 31% of global manufacturing. So that's really the problem. When China was a much smaller share of the world, it could expand manufacturing without putting too much pressure on the rest of the world. But it already accounts for nearly 1/3 of global manufacturing. So any expansion driven by an increase in the manufacturing share of GDP must be accommodated by a reduction in manufacturing in the rest of the world. And if you look at what they're saying in the US, in India, Japan, Europe, it's not really clear where that contraction is going to come from.
On the property sector, Michael, we talked to Standard Chartered CEO, HSBC CEO earlier this year. They say they do see a bottom starting to come through for the property sector. Do you see a turnaround in that sector this year?
Not yet. Property prices reached levels that, we hadn't really seen before, except in the case of Japan in the 1980s. So they're still pretty expensive, and I think they're still going to come down. I think there will be more attempt to slow down the pace at which it comes down. But so far, it's been contracting pretty rapidly. And at best, we can get a slowdown in the contraction.
And as we look ahead, and we have to think about politics always now when we think about the Chinese economy, we look ahead to the election in the US in November. Does either Biden or Trump, whoever comes to power after that election, change the dynamic for China's economy?
That's a really important question, Tom. And I think a lot of people assume that it is going to change because when we think about Biden's policies, they're focused towards what is called industrial policy. Whereas the people around Trump have been talking more about trade policy. But I think the important point to make here is that from an economic point of view, there's no meaningful difference between trade policy and industrial policy. In both cases, they represent policies that are going to shift income from the household sector to the manufacturing sector in an attempt to grow the manufacturing share of the U.S. economy. So no matter who becomes president, I'm pretty sure we're going to continue moving in that direction.
OK, really, really valuable insights as the National People's Congress wraps up in Beijing. Michael Pettis, Senior Fellow at Carnegie Endowment for International Peace. Really appreciate your time and your insights this Monday. There is plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Yes, we're going to look ahead to CPI to the US on Tuesday, but for now, the speculation around the Bank of Japan is almost at fever pitch. On the back of the news that they avoided a recession the most recent quarter, wage data, of course, remains relatively resilient in terms of the pickup that you're seeing in wages out of Japan. So expectations building that they could then go next week in terms of moving out of negative rates. You've seen the strength come through for the Japanese yen, 146. Does it cross through 145? Where is that level that's going to be support in terms of USD JPY? But for the moment, the strength for the yen, the uptick in yields, pressuring Japanese equities. They fell. The last time I checked, the Nikkei was down around 2%, over 2%, one of the biggest drops in about a year. So we continue to focus on the BOJ story and the speculation that maybe they will finally move out of negative rates. Stay with us. Coming up later, Eurogroup President Pascal Donohoe is going to be speaking to Bloomberg exclusively later in the show. Stay with us. This is Bloomberg.